Hi, Abe. Thank you so much for coming on to the Venture with Grace today.
Thanks for having me, Grace.
Awesome. Okay, so to give the audience a little bit of background, Abe is the founder of Congruent Ventures. And before that, he was in the industry for 18 years, investing in sustainability. And Congruent Ventures invests in pre-seed, seed, and early stage A climate and sustainability companies. And typically, among other like industrial investors, in institutional investors. Anyway, so you guys recently raised a $275 million fund, and then you guys had to say no for like $300 million to LPs. Why is that? By the way, congrats. Like
Thank you.
it's like a really terrible climate to like raise funding in general. And then also like after my stalking from like, my climate journal, like my climate journey podcast, like I feel like basically your industry is kind of like a crypto industry. People come in flows, and then you mentioned that like at one point you went to your wife's like holiday party. There's like this one person just asks you, oh, I'm so like what you do, and then you're like, I'm in like climate tech investing, and then she just like left. But anyway,
yeah. There's a lot of stories from those days. I just kind of that quick history, and then actually before we get in there, Grace, I have to say, I last night I was in bed trying to figure out what was going on, and I was reviewing some of your work, and it's quite prolific. It's amazing. You've had some
thank you
wonderful
so
guests,
much.
and I've been very impressed with what you put together.
Thank you so much. Oh my God, this is going into a clip. Any
Yeah, great. Here
compliment
we
is
go.
going into a clip. Yeah.
You're gonna have
Anyway,
just
I
embrace
heard there
compliments.
is a anyway, there's a company called Solyndra. So it sounds like it just sounds very crypto, by the way. But anyway, I'll let you go. Like I'll let you keep going with whatever you were saying.
Yeah, sure. I mean, just a kind of quick history without belaboring it. I've been doing this now. This is actually my 20th anniversary month in climate tech venture. We used to call it clean tech venture. I don't know whether to be proud of that or not. There are some both good things that have happened and some very bad things that have happened over the years in the climate world. But the reality is that LP capital was flowing in quite heavily in that kind of 06 to 08 period. And then for a variety of reasons, nobody would touch climate and clean tech with a 10-foot pole for like 10 years, basically. There was
why? Like, okay, so why is that? And I also wanted to ask you like how the money flow in the industry. And why do like LPs suddenly get so like overwhelmed by like, I don't know, basically like sometimes they really, really like it, sometimes they really, really don't. Um, Although it's like I know there's a thing called hype cycle, but like this is like not the typical hype cycle. I feel like it doesn't really come like every 3 years. It comes in like a more long term period. So I would love to just get your like thoughts on this.
Well, maybe a little bit of kind of history on it without again taking too long on it. But if you kind of look back through that, I started in the business in like February of 04. So that was when I jumped in. But if you're a student of kind of the venture industry, that 2000, 2001 bubble burst, what you ended up happening, it was a whole bunch of committed capital, as in LPs had invested in GPs and managers. And there was a huge overhang of capital, and there was a lot of value destruction, post.com burst. But what you ended up having is a lot of GPs, a lot of funds that had a huge amount of expertise in actually in semiconductors and biotech. And you had all this capital to deploy, and there needed to be a new thing. And that's kind of how the venture cycle has worked. So The Inconvenient Truth came out, Al Gore. John Doerr kind of picked this up at Kleiner, one of the most famed investors, in the history of venture, and started talking quite publicly about how, they called it green tech was the next wave. And so as hype built in that kind of 2004 or 5 time period, and there was a lot of committed capital that was, had nowhere to go in traditional tech, every major venture firm started thinking about doing clean tech. And they usually dedicated a person, maybe a couple people. Sometimes they put a practice together. Sometimes they do a little skunk works. And all of this hype built. Now, my old firm, I was there for 13 years. All we did was clean tech. And so I started in 04. In 07, they shipped me out to Sand Hill Road in Menlo Park, where all the traditional venture industry used to hang out. There's still quite a bit down there. Andreessen's still hanging out down there. NEA's down there. And my job was to syndicate with all the mainstream funds coming into the space. So as we kind of had this hype cycle build, despite being, kind of pre-revenue, early revenue, a lot of these companies had, hundreds of millions of dollars deployed into them. Before 07, 08 comes around and, the GFC hits and everything freezes. Well, at that point, a lot of those clean tech companies had been funded with large amounts of capital, had increased burn dramatically, and did not yet have any real, revenue and or margin accretion. And so the first deals that really started popping off in, venture broadly were a lot of these overfunded clean tech companies. And it was just death and destruction everywhere. And what ended up happening from that kind of 08 to 13, 14 period is that a lot of those companies, died. Most of the managers, most of the GPs who were investing in the space left the building. LPs, the kind of cardinal sin in LP land is looking like you have produced returns on paper and then not even producing like cost. So you might be sitting at like 3x, the value that was invested. And what if you give 75 cents back? Well, the problem with all these LP aggregations is they will look at specific asset allocations. So, maybe 1% of a, $100 billion asset pool goes into venture, 10% into privates, 10% of the 10%. So 1% is into venture. And all of a sudden that number ends up going to 3% because of high performing illiquid marks, but actually it produces 0.5%. It screws up their entire allocation. And whoever at the LP is responsible for allocating those dollars gets into hot water. And so everybody, dropped clean tech like a hot rock. And as a result, no new funds were raised basically for 5 or 10 years, particularly in the earliest stages. And so there was kind of this like total doldrum period. Most of the existing managers focused on, now climate tech, then clean tech, left the building. And there are maybe 20 US investors who actually were investing, before 08 that remain investing today. Most of them are in kind of growth, not in early stage. And so the Congruent story actually was in 2017. My partner, Josh Pusman-Tier, and I put together Congruent to focus on the earliest stage of capital formation across climate, hardware, software, tech-enabled services. Anything that touches climate in the US is fair game, but we are investing like it is typical venture. We have a traditionally structured fund. We invest in companies that we believe will go through a traditional venture underwrite at the next stage. And that's what we focused on, building an institutional firm focused on the earliest stages of capital formation to try to help reboot the cycle in climate. We were one of the first early stage funds back into the space. You asked specifically, like hype cycles around this. A lot of these industries have hype cycles. The reality is that with the clean tech and climate hype cycle, the first hype cycle didn't produce a lot of durable returns. There's actually a little mini bubble in kind of 2000, 2001 as well. Ignoring that 08 hype cycle, nobody got liquidity. There was actually the SPAC boom. A lot of those, about 40% of the SPACs were actually climate and sustainability related. So there were some returns there, but those have, since taken a hit in the public markets for the most part. And now there's a, steady stream of rebuilding of appetite. And so a lot of times we kind of get the question, well, is this time different? What's different this time? There is no easy answer to that other than it is like many threaded. There's like 7 or 8 fundamental reasons why things are different this time. But I'd say the easiest to understand for those who aren't sitting and understanding how the utility models work and, the pressures on stakeholders for climate reporting and all this business that we live in every day is that climate change broadly, the science of climate change basically remains unchanged since the 80s. This is not new science. This is what Al Gore did with The Inconvenient Truth, was shine a light on the existing science. The difference really since starting in 2017, 2018, is that I think the average person now is feeling it. It has gone from an intellectual exercise to the world has literally tipped. There are wildfires, there are floods, there are hurricanes that haven't been seen before in the history of humankind. And everybody in, certainly in the US and worldwide is now firsthand experiencing, a different climate. Anybody who's over 30 years old, will remember literally a different climate than we're living through right now. And it is gone from like this is a future problem, I'm going to focus on my day to day, to oh no, like this is not just going to focus on my children or my children's children. This is actually going to affect me. And markets are made of humans and emotions, and when people feel personal pain and responsibility and ownership, then they move. And that is really what's happening at the consumer level and the enterprise level and the societal level, is that people are waking up to the fact that the climate is changing. Even the climate deniers have stopped saying, it's like the climate is changing, it's just not our fault. That's kind of the new climate denial, because it's so irrefutable that that the actual climate is moving.
Totally. Why do you pick like you have like major 4 different subsector that you are interested in, right? So like sustainable product and sustainable production and consumption, energy transition, food and agriculture, mobility and urbanization. Why do you pick these 4 sector?
Yeah, it's Josh and I have saved our original categorization. The kind of the meta story for us is, again, anything that has a positive climate impact at scale is fair game. And so then the question is marketing. It's like, how do you describe it? We're basically talking about rewriting the entire economy. We have to decarbonize every aspect over time of the economy without asking anybody to give up their life and their personal choices. And that tension is very real. And so when you talk about, the various parts of the economy that matter, it's kind of everything. And so how do you pittily describe like what we're covering? Well, we started out with like 13 different categories with subcategories in the initial, LP pitches, that when we went out and it was actually 2016 when we started raising. Our first fund, first close was 2017. And everybody was like, all LPs were like, this is too much. Nobody can know about all these different industries. This is ridiculous. And so we put our heads together and went back and we just took everything and we made it into 4 categories. And then all the LPs were like, oh, this is interesting. This is super clear. Same stuff. So it's all marketing. But the marketing is the following, which is we have divided it up against kind of 4 areas. It's really everything that touches, the physical world. The first is around mobility, urbanization, transportation, and the built environment. So this is everything about how we move goods and services, and how we live. Your homes, how you power your homes, which is a slippery slope into the second category, which is energy transition. That's really about everything going fossil fuel to renewable fuel and centralized to decentralized. So a lot of that is kind of grid tech. There's a lot of crossover into EVs and mobility, as well as powering the built environment. Distributed energy resources, does that go into energy or does it go into built environment? You could either argue either way. The third category is really how we feed ourselves. It's everything about food and agriculture, upstream agricultural practices, downstream new food products. A huge amount of greenhouse gas emissions are related to the entire supply chain around food. There's a lot of food tech that isn't climate. That's great stuff, but not for us. The last category that we cover is a broad category we call sustainable production and consumption. Again, if you actually look at greenhouse gas emissions, a lot of that, again, is in the stuff that we buy. It's in the supply chain. Apple is actually exceptional at greening their supply chain. So when you buy an Apple product, it has a much lower greenhouse gas footprint than most other products out there. But they've had to be incredibly thoughtful about their entire supply chain to get that there. So that last category is how you produce, how you manufacture. It also bleeds over into mobility because we have logistics in there as well. Not just any logistics; it has to have a efficiency footprint there. And the last piece is that there's a lot of business model innovation that you can employ to address climate. And so there's a closed loop business models. We have a number of those companies that are scaling quite gracefully, actually. across the portfolio that are tech enabled, but aren't necessarily a traditional tech company. But it's a business model innovation more than anything else. So again, the idea is to have a breadth that covers everything that hits climate, but a depth across business model innovation as well.
When you are thinking about like, so basically another thing is I feel like this is in so many, all your investment are in like actually so many different sectors, although they all touch like climate. And I'm like just currently like looking at your report from your company. I think this is like super well rounded, and I really love that it just covers literally everything you have invested in. And I feel like I wonder like how do you quickly study each sector, and in terms of like thinking about things that touches climate, I wonder how do you think about what are the most like profitable companies in each different sector, and what's your thinking framework on like capturing all of them, because this is like such a broad industry. I'm looking at currently just looking at the energy sector. There's Span, which is like a award winning, like basically a charging product. And then there is I just saw like there you guys had like the packaging for different food, and then there's like meaty, there's like arm robotic. So basically there's like so many different things. If you're investing in like so many different subsectors, how do you, I guess, like quickly study each sector on what would be the most impactful thing to look at in each different sector? I'm sorry,
Yeah.
my question is like so quick.
No.
I'm just like really impressed by like how many different thing climate tech touches, but on the other hand it's like it's so broad that like how do you quickly identify the opportunities there?
I'd say you don't quickly identify them is the short answer. So this is one of the challenges, actually, which is historically speaking, and this is kind of the same question I was referencing when we first started out, is like, how do you actually understand all of these different industries? This is a ridiculous statement. And, we can't be experts in everything, but I will say that this is not our saying, but opportunity favors, the kind of the prepared mind. And so the fun of doing this for the last 20 years is that over the years, now our full team, not just my co-founder and myself, have been spending time in all of these sectors. You can't learn these things in 2 months. You have to soak, you have to see what rhymes, you have to understand where the bodies are buried in every one of these sectors. Selling software and services to the built environment, where you have a massive stakeholder problem of owners, leases, triple net leases, owner occupied. It's a total mess. You can sell things into the built environment, but you have to understand how the entire value chain works. Same thing for utilities. Same thing for agriculture, which is different than food and distribution. So the fun of this business is, I think if you do it well, you have to be intellectually curious enough to understand kind of what makes things work and what makes things fail in each kind of little sub-industry. We are not going to be experts on every single one, but we know where the bodies are buried in most. And so we understand what tends to work. The fun of that is that, we start early. We'll start, we're pre-seed, seed, and Series A at entry. And that's kind of 500K up to, $4 or $5 million at entry. Sometimes that means that it's like 2 people in a garage with a dock. That's kind of the entry point. And the key that we look for is, and this is very common in venture, especially early stage. We look for people. We look for the people who actually understand what they're doing. It doesn't mean they need to come from the industry. In fact, in the last 4 or 5 years, a lot of people from tech have come into climate, which we love. We think that is a huge net positive. But if somebody has been a student of the industry and figured out what's going on to develop a product or service and can deliver the narrative that says, hey, this is what we're going to do, and they understand the nuances of given space, that's what we're looking for. Oftentimes you'll have somebody coming in from tech and it's like, hey, I can deliver this. One of the most common, I can use AI to optimize, HVAC systems. So like heating, air conditioning in large buildings. In fact, you can. There's a huge amount of efficiency to be gained there. The reality is that it is almost impossible to get that software deployed on building management systems at scale because of the stakeholder problem. So if somebody comes in and says, hey, I'm going to do this, and I understand that stakeholder problem, and I've got some early traction, and this is why, that's really interesting. If somebody says, I'm going to come in and develop this really cool piece of software, and when I build it, they will come, there's not a chance that we're going to give them money. And so it's kind of that understanding of, the channel to market, the stakeholders in these very old line industries. And that is probably the least common denominator, is that all of these industries have been around for, hundreds of years. And selling new products and new technology into those industries, you have to really understand the value chains. You have to understand the stakeholders. You have to understand how things are done. Otherwise, you will not get the adoption of the fancy new tool that you built.
Totally. I want to say hi to the audience. Hi, Hillary, and hi, LinkedIn user. I have a question on okay. So I think one of the LinkedIn users' question is like really good, but we'll save that after this question. So I wonder, you mentioned like you have to know where the body is buried. Like, what does that mean? Can you give us an example using one of your portfolio companies?
Sure. This one just released a new fundraise 2 days ago, so I'll get to talk about it. So one of the favorite punching bags of venture in climate is building software or hardware to sell to utilities. So utilities are, this is kind of broadly the group. I'm specifically speaking of power utilities. Power utilities sell you your electricity. It is a highly regulated industry. It's different. The regulatory construct is different in different countries. And in fact, it's quite different across the US. Every state has their own public utility commission. There's also 3 separate business models in utilities. There's something called an investor-owned utility, which is like PG&E if you live here in the Bay Area. And those are actually, you can go buy shares on, these are publicly listed companies. You can go own some of your own utility company. Those have to be heavily regulated. And what ends up happening is that the more they spend in CapEx, the more their shareholders make. They get what's called a regulated rate of return. That means that their adoption cycle is regulatorily driven for anything at mass. That's a 5-year sales cycle, best case. 2 years to get a pilot, a year of pilot results. And then if you get the rate case right, you're in good shape. So if you kind of rewind the history in clean tech, there are, tens of companies that went out to build new products to sell to utilities. And they all said, hey, those are the biggest utilities. I'm going to go after the IOUs first. Well, it doesn't really work because you can't be a startup burning money for 5 years after you've built the product. So this is like 7 years before you get your first real sales. That doesn't float. There's 2 other utility models out there. There are things called munis, which are municipal owned, and there's something called a co-op, which is actually customer owned. Well, co-ops are actually very economic. They can make decisions in like 2 months. Munis can be economic. Some are very well run and some are quite political. This is sometimes governed by a city council or something equivalent. We have a company called Camus Energy, which was built actually by some of the original product and engineering leaders of Google's SRE. This is the site reliability engineering team that effectively is now more DevOps, but originally built the software architecture to run all of Google's compute. So the 2 co-founders there were very much focused on taking that discipline of understanding how to use distributed systems, which is how Google deals with life on serving up compute to all of their services, and apply it to the grid. So they built a software platform specifically to go after the co-ops with an appropriately sized, packaged, and priced software package that will initially go after co-ops. They got some real head of steam on adoption co-ops and then lived through the adoption cycle where they actually already have an IOU who is now adopted. And the fun of these industries is that they've got great customers. They just take a while and they don't compete. They're regulatory driven. And so once you have a big IOU and a series of co-ops that have adopted, all of these groups start falling like dominoes. They're like, oh, does that software work? Is it solving a real problem? Is it saving you money? Yes, yes, yes. Sure, I'll buy that. And they have big budgets. They pay well. And, they're wonderful counterparties. It just takes a long time to get up the hill. But if you go out to, most people who have been investing in the space, and you say you're trying to sell anything to utilities, it's like a flat out no. if you know and you understand the various utility models, why they do what they do, and how you can drive adoption with the right product and the right go-to-market, you can address some of those challenges, and you can still make a lot of returns for your LPs. And so this one just announced the Series A1 that we had actually ended up co-leading, and some of our LPs joined us directly into the company as they scale, which is a lot of fun.
Mm. So basically, this software supports the integration of EVs and renewable energies. Basically, I guess like who are they selling it to? Are they selling it to, you mentioned like um is this like energy? So like, do they sell like the software to the energy companies, or like do they sell to the government? And I wonder from like a broader level, like what type of customer, like what type of customer should a company shoot for? Because we see some of the industries like, previously we had people from like security or defense came in, and then they are only
Yeah.
selling it to the government. When I'm thinking about climate tech, I feel like it's a really addressable problem, like from a global and the government perspective. I wonder how does these like laws shifts changes like how you guys invest in these different sectors, because I know that there for EVs like there is some sort of like grant that's kind of like helping people adopt into these different um like cars or whatever. Basically you can get like grants from uh switching into EV or like buying a certain type of cars. I wonder like how do you think about like the customer from this level? And then also I'm also asking because I think, previously I also chat with like, healthcare investors who are into like robotics. I know that you guys invest in robotics, and it just kind of like making me thinking of like, how easy or hard it is to sell in the industry, and then what are things that people shouldn't be touched.
Yeah. So this is a very, very complicated answer. So I will try to distill it into some form of simplicity. Maybe taking a big step back, in general, our view is that people are not going to pay a green premium for
Mm,
anything.
mm,
Industries won't, people won't, and corporations won't. And so what drives adoption of decarbonizing technologies? Well, there's really two things. And the one is economics, and the second is policy and regulations. The way that we have thought about our investing is really primarily focused on the first. It is economics. Better unit economics, better for the customer, better for the planet. In the last couple years, we have had to focus a bit more on the policy environment for very good reasons. So maybe quick step back on the policy side. In general, the US has not really had an industrial or energy policy for the last 50 years. It has kind of been, off and on, no specific subsidies. And this is in the face of the world actually specifically carving out decarbonizing technologies as strategic imperatives. South Korea has done so. China has done so. The European Union nations have also done so in very different ways. Pretty much every country, is industrialized country in the world, has actually put together some kind of policy. Well, the Biden administration, in particular, passed something called the Inflation Reduction Act. Oh, sure. My camera has died.
oh no. Oh
Oh no!
no.
Right in the live stream. All right, let's see if it's going to come back on for us. Hold, please. Oh, the wrong camera.
It's okay. This camera also have a great angle.
All right,
Except
we're
the
going to try
microphone.
one more time. Yeah,
Okay.
and then I'm going to switch over and give up if that
Oh,
fails.
you look great.
Okay.
Okay, you're
All
back.
right. Thank you. The hazards of live streaming, right? No editing. So the Inflation Reduction Act was passed, which basically covers industrial policy. It's really manufacturing policy. It is pushing out a huge set of subsidies actually into manufacturing. Most of those manufacturing subsidies and jobs are ending up in red states. It's literally like by person per capita, there's like $2 for every $1 going to a blue state. $2 goes to a red state, $1 goes to blue state. And it's mostly for like battery manufacturing, automotive manufacturing, solar manufacturing. These are like very high quality, skilled blue collar jobs that are getting pushed out. There's also a host of other subsidies like you were referencing. There's if a car was built in the US with a US supply chain, you get a quite a nice tax credit for going with an EV. So there's a host of these subsidies. They're still being rolled out, although the policy was passed. The actions are taking a little while to get out in some of these cases. For low and moderate income communities, you can actually, for example, get a SPAN panel. You can upgrade your panel for electrifying your home basically for free. That's part of the income qualifying tax provisions in this. This is like a massive policy. Just to give you a sense of it, Goldman Sachs believes that it will stimulate about $1.2 trillion of capital to be invested in the U.S. economy over the next now 8 years, which is massive. But that's all like icing on the cake. The reality is all of these technologies, or most of these technologies, are already economic today. And so my favorite example on this is, if you kind of stand up California and Texas. California, we're all tree huggers, we all love the environment, we don't believe in freedom. And then you have like the Texas meme, which is like secede from the union, personal freedom, we don't care like what the energy looks like, just give us our energy. And I'm making generalisms, but the reality is if you put up solar installations in California and solar installations in Texas, your assumption would be that California is way ahead of Texas. Well, what's actually happened is that solar, for example, and batteries, like large-scale grid batteries, not just in your home, are dramatically economic. It is like way cheaper to produce an electron for your home from a solar system than it is from a natural gas system. And in fact, they are much more reliable. They're not always on, but they're much more reliable. You know when they show up and you know when they don't. That's not always the case for traditional fossil fuels. And so what's ended up happening is that California, while it has a huge amount of kind of regulatory pressure to decarbonize, it's quite difficult to build things. Well, in Texas, there is no regulatory pressure at all, maybe the opposite. In fact, there's a lot of hatred of renewables, but they're cheaper and it is easier to build. So Texas last year surpassed California in solar because it is easier to build, it's easier to permit, and it's just dramatically better from an economic standpoint. And in the coming years, Texas is just going to fly past California. And they're not doing it for policy. They are doing it because it makes economic sense. And that's going to be true for EVs as well. EVs are cheaper to drive. They're cheaper to drive. They're more fun. They have less maintenance. Their total cost of ownership, which is kind of the industry term, is cheaper. Now, can you drive 500 miles without refilling? You cannot. Is the EV infrastructure outside of Tesla there to actually have a cross-country trip? Not particularly, but we're going to get there. In fact, the Inflation Reduction Act has a huge number of provisions, as well as another separate act as well, called the Infrastructure Act. I'm missing an acronym in there. Has a huge amount of subsidies to build EV fueling stations effectively across the U.S. And the only thing holding them back is permitting and connecting to the utilities system. But there are hundreds of developers out there building new fast charging stations so you can plug in your Ford, going across the country.
Totally. Okay, I want to quickly address. We have so many audience questions, although I was gonna save it at the end, but I think some of them are really interesting. So, hi Philip, hi Robert. So let's address LinkedIn users' question. What is your emphasis on hardware hard tech investment / battery carbon capture versus software such as DERMS or VPP or fleet software, etc. They're so technical. Like I'm thankful my audience are a lot smarter than me, so I'm like, thank God. But anyway, keep going. Sorry.
I mean, this is one of the challenges. There are so many acronyms in our business, and it's like you kind of get into these little. You could spend your entire career, what that expression is DERMS, DER, Distributed Energy Management Systems, DERMS. It's like this is a utility lingo, and it's great because you have to know all these things to invest, but it's not very easy to translate. So what's our focus? So the way that we think about life and how venture applies to this. So I'm going to answer this indirectly, and then I'm going to answer it directly. The indirect answer is that venture capital innovation is like a very fun, very real, very cool tool set that is entirely insufficient for addressing climate change. We are like a small part of the overall climate picture. We're important, but we're not that important. We can't pretend like we're going to solve all of the world's problems, because we are not. As we think about that at Congruent in particular, and not every firm thinks the same way, we have a very clear focus on producing venture-grade outcomes for our investors. We have institutional LPs that are interested in venture-grade returns. For some of them, they care deeply about climate. For others, they're like, we want to invest in the best manager focused on climate, because we think there's actually real returns, because the world has a decarbonization problem, and it will require innovation to solve that decarbonization problem. So it's an asset allocation story, not a tree hugging story. And so as we think about that, when we do our early stage underwriting, we have to kind of go back to the first principles of venture capital. And if we think through that, really what the venture business is, and I don't want to distill it too much because there's a lot in here, but it's a game of supporting entrepreneurs with capital, and then finding new ways and new people to support the entrepreneurs over time. And by that, I mean, if you're investing $10 million in a Series A, the idea is to help support these companies and entrepreneurs to actually build something, get into real revenue, and then go out and raise maybe a $20 million Series B. These days, 2 years ago, that would have been like $50 million. These days, it's a $20 million Series B. And then hopefully your enterprise value increases more, and you find somebody else to do the Series C. And eventually you get down the shareholder line to get to a public company or an acquisition that is worthwhile for all investors, particularly the early stage investors, and of course the founders. The fundamental tenet of that is that the company has to be worth significantly more on average after you invest than before you invest. It sounds really stupid. It's not that complicated, but it's really lost in translation, in particular in our industry, because many of the things that affect climate are physical world problems. It's hardware. And sometimes those things take $100 million to figure out whether it works. Well, if a company thinks that something is going to take 100 million, it's probably going to take 200 or 300 million. It's going to take longer. And if you actually look back and you peel back the onion on the venture model is not built at early stages to have the reserves to support a company for a $100 million round, support the company more, own enough of the company to then actually pay for all of your sins in losing money in some of your companies. You have to make up for all the holes. And if you have these $100 million check sizes to get out of bed, you're probably going to fail on average. You may hit a couple, they may be world changing, they may be very impactful. But if that first round is 100, 200 million bucks, we're out. So because you just cannot predictably have, say you have a $100 million, round on a $100 million pre, the entrepreneurs have already sold half their company, right? And then you better have more than the $200 million post at the next round. The history of this is like, on average, it's like a $50 million pre at the next round. Everybody loses money, and you don't have enough reserves to protect yourself, in the future. And so the way that we think about investing across climate is it has to look and smell like traditional venture. There is a lot of hardware and deep tech, if you understand how to invest, that does in fact fit that model. But something might take 10 or $20 million, that can fit. To figure out whether you have product market fit, whether you've got real customers, and whether the enterprise value has really increased. And so the arbitrage game that we play as early stage investors is investing in companies and entrepreneurs who we think have the capability of delivering enough milestones to attract non-expert investors at the next round. So if we do a Series Seed or we do an A, the hope and expectation is at the next stage we'll be able to attract mainstream capital who doesn't know what a DERMS platform is, doesn't know what a virtual power plant or a VPP is. Like, we don't want to be in that language when we're going out. We want to be talking about, hey, Camus is doing X amount. They're doing 10 million in revenue for their Series B, the company I was talking about earlier. And it's a SaaS business with customers that have, wonderful net net revenue retention, and it looks like a SaaS business. That can be underwritten by venture without understanding the nuances of all of the weird acronyms that we like to throw around climate.
That's such a great answer. I want to talk about, so we still have like many really good questions. And I want to talk about like, so you invest in a company called AMP Robotics. I believe you guys invest in seed, and then like Andreessen invests in like later round, and it's like growing really fast and all that. So I wonder, when you're looking at these deals, like I feel like there's a lot of, when you mentioned like it's really capital intensive to invest in some of these like climate deals, especially in EV or anything that's kind of like involved with hardware. Um, what's your thought on like, when you're looking at these robotic companies, like they may cost a lot to manufacture something. I wonder like, what's your thought on like what are the economics that make sense for companies that before you invest in them?
Yeah, going back to kind of the same language I was using about a quantum of capital to de-risk something to make it worth more at the next round, that is venture capital. If you look across the history of venture and returns, what you will see is that there are many software businesses that, in fact, were not capital efficient. The difference is that the value creation was front-loaded. Then they raised $200 million to scale. And when you have outcomes that are many billions of dollars, in nominal value, at the end of the day, that will work. And so the challenge there is not capital intensive by nature. Like venture can actually handle real capital deployed after you have a viable company. And so there's this like myth that everything in climate and hard tech is not capital efficient in the same way. We don't agree with that. I do agree with it with some of them. So if you're building, for example, like direct air capture, a massive plant in the middle of the desert to suck in carbon dioxide, that stuff is amazing. And we're going to need it over time. Does it fit the near-term venture model? In our opinion, not so much. In others, for sure. And the world needs it. So I'm delighted to see those companies support it. But it is very challenging to make that work. When you think about some of these robotics businesses, so AMP is a fun example. So we did, just kind of give you a quick history on that. We effectively led the seed, not Andreessen, but actually Sequoia did the Series A. And then XN, Valor, Google Ventures, a number of companies did the Series B. And then we actually co-led with our growth fund the Series C alongside Wellington, and had Blue Earth and a couple other funds join us in that fund, as well as actually the Microsoft team. And as you think about that, what they actually did is the founding CEO, Matanya Horowitz, he was a PhD at Caltech doing machine learning. This is AI for path planning and robotics. That was his PhD at Caltech. And he actually focused on machine vision quite specifically, and figured out that you could use image classifiers. So this is kind of a form of AI to deal with a very hard problem of actually just taking an RGB camera, so like a normal camera, and identifying all of the waste going through recycling. So if you think about like a waste recycling they're called MRFs, material recovery facilities, more stupid acronyms, but a recycling facility, there's conveyor belts, and literally humans are mostly picking all of your recycling. You think it's like fancy and automated. Actually, it's just people picking your stuff off the conveyor belt. So he took a camera and he's looking over, the conveyor belt to literally identify now down to the SKU level of what everything is. And you think about like a milk jug. Well, a milk jug in perfect lighting when it's full of milk is pretty easy to identify. A milk jug that is occluded, dirty, stuff all over, crunched, does not look like a milk jug. So actually a very, very difficult ML problem. He solved that, took an off-the-shelf robotics system, and started picking, trash off the conveyor belt. And because it was actually a software problem for the most part, it was not that expensive to kind of get their first proof of product. Then they started selling a lot of robots, and that's when Sequoia came in and led the Series A. Now they have vertically integrated, and they're working with the existing waste providers. This is think of the Waste Managements and the Republics of the world. These are, kind of the folks you see hauling stuff out of your home across the country. There's a lot of regional activity there. And they are offering to basically sort as a service. So it's a vertically integrated strategy where they will take in the recycling. And because there's no labor, they do a much better job. The kind of purity of all the recycling streams is much, much higher. And the labor costs don't exist. There's like a couple people manning these automated facilities effectively. And it is literally going to revolutionize waste over the next 5 years, all because you're solving some of these fundamental sortation problems with actually machine vision, AI, and some fairly straightforward robotic approaches.
So you mentioned basically this person was a PhD from Caltech, and then he discover, or like he like kind of like created this type of technology that can identify all the waste throughout the production process, I believe. So I wonder, like for the PhD, when you're investing in these like really highly technical talent, assuming they have the technical mode down, but like however, when you're judging their business ability to turn this into a profit, what are some ways that for you to kind of evaluate if this person would be a good like business person?
The key on that is there's no easy answer, but the key is, again, back to their understanding of the customer base and the industry in which they're investing. And oftentimes, in a lot of these industries, again, they're kind of old line industries. There is a natural and sometimes appropriate rejection mechanism for kind of Silicon Valley innovation. So if you kind of get the, like the, hey, I'm going to solve the world's problems, view, and you come and you start selling to utilities, or you start selling to the VP of operations at a recycling facility, which does not smell like enterprise software when you go and visit. These are like trash dumps, there's a natural rejection mechanism. The thing that we look for in a technical founder who is tackling an industry like this is a fundamental understanding of the customer. Do they understand why the people they're selling to are motivated to do what they're doing? Are they solving a real problem? Are they taking the customer feedback? Do the customers like them? I mean, literally at this stage, it's like sometimes a customer is like, stuff works just fine as it is. They don't need to do anything new with their, industry. They do it because they're like, hey, this guy seems smart. He's like helping me with something. Sure. But you get that he had when we invested, he kind of got some grants early on from like the National Science Foundation, and he had like three of these systems operating at MERF. So we called up the MERFs. They're like, hey, do these things work? And one was like, well, not really yet, but like he's really nice. He keeps showing up and fixing stuff. It keeps getting better. And it was pretty clear that like he was going to get there, and that he had spent enough time understanding the customer mentality to actually get over the hump and build something that actually mattered to them. And so that's what we look for, is somebody who really understands the customer journey, understands the industry. Doesn't mean that they need to have a business background. Sometimes they do, but we back a lot of technical founders.
When you were thinking about if you're doing angel investing in the current space, what are one or two subsector you are super excited about? I personally really like the meat, like so like you invested in a company called Meat, I think. So
Meaty,
like
yeah.
Meaty, yeah. So I feel like that industry just fascinates me, like basically the meat replacement industry. I don't really know if there's
They call it alternative proteins, but there's like 10 different
alternative
names.
proteins. Yeah. So the Impossible Burger
Yep.
of the world. So like I wonder, but like it's kind of like too late. The people are doing like the stem cell Simon right now, but like I wonder what's your thought on like what are something that excites you if you're investing from like a even earlier stage than where you are?
Well, so there's a lot of different, I can get on a lot of different soapboxes about this. The angel investing is a different mentality than venture investing, I think. So, and by that, I mean, if you're doing angel investing in the sector, you don't necessarily need to get exposure to these companies that have the potential to be, $10 billion outcomes. Well, sure, that's great if you can do it. The problem is there aren't that many. There haven't been that many massive outcomes in climate compared to traditional tech. Which is a whole nother discussion to be had. But there are industries right now that are going through such fundamental change that the kind of the rising tide is going to lift a lot of boats. One of those in general actually is in electrification of transportation. And I would actually say that there's a whole host of customer problems, and there is a whole host of problems you can address with software and services without even touching the hardware stack. I would actually discourage you from touching the hardware stack as an angel, because it gets very esoteric. You really have to understand where whatever you're doing fits in the ecosystem, who's going to use it. There's a lot of software and services businesses that are within the kind of the EV landscape that are going to have some really nice returns that may not be billion-dollar returns. We've invested pretty heavily in the space. We were early investors in a company called AMP, which was developing charging stations as a service, basically, for fleets. It's now BP Pulse, so it's BP, British Petroleum's EV fleet charging business. It got purchased a couple of years ago. We went back in. We made 3 other investments there. One in a company called Presto Charging, which you can actually go and download an app. It's basically a meta app that allows you to pay for all of the non-Tesla charging, but more importantly, it will tell you which ones are working and which ones are not. About 40% of the time, if you show up at an EV, a level 3 charging station, like so a fast charging station with a non-Tesla charger, it doesn't work. That's a very big problem. So they basically turned off all of those on their app so you don't show up and have a really annoying experience. And they're getting massive adoption with actually Uber drivers who are driving EVs. And also if you fly into SFO or LAX, actually Hertz is now having you download their app to charge your car as you drive around, which is kind of fun. We did another one that's a software business for fleet charging. So it connects to the kind of the vehicle telemetry where these buses, trucks, cars are, and connects it to the actual chargers that, fleet might own. That's getting great adoption. That's another software business. And the last is a business called Stable Auto, which allows the people developing all these charging stations to actually figure out what the utilization is going to be. In other words, who's going to show up? Tesla can figure it out because they know where all the cars are. Nobody else has a clue. And so they built an actually ML-driven system to predict utilization of a given site over the course of that site's life. And they've now introduced a pricing algorithm because, like, when you go to the gas station, those gas prices are informed by actually a third-party service that tells the gas stations what to price it at in general. There's no such thing in the electric vehicle charging space. And so Stable is producing that software stack to serve the people who are running those EV stations. So there's like a lot of these kinds of things out there that you can get exposure to.
For sure. Is it too late to invest in this space? Because it sounds like, the top players are already invested by you guys, which is a lot later than angel investing.
I will say that I think unequivocally, no, it is not too late. We're at like maybe inning 1.5 to 2, second inning in a 9-inning game here of the whole decarbonization space. The challenge is that, again, you kind of get into all these weird little esoterics. You do have to know what's going on in each one of these little sectors to understand whether you're too early or too late. Broadly speaking, we're super early. We are just getting started on decarbonization. There's going to be more and more opportunity over time, not less. But it is very easy to get blown up in an individual silo.
Okay,
so alternative proteins is a good example. Like there are a lot of those. There's a lot of folks who have not had good success, like, beyond an impossible or not selling as much as they used to. So there's been a lot of challenges around that stuff. We're very excited about Meaty. You can go buy that at Whole Foods and other places, which is kind of a whole muscle alternative instead of a ground alternative. But it's hard. You do have to understand each of these.
Is this is Meaty or like the sector, like what should people pay attention to when they're investing in that sector? Because I also heard mixed things. Like some are like, oh, the valuation went really up, but like on the other hand, it's like there's no exit, and then TLDR, it's like, is this actually profitable, and like what should people even pay attention to in the space, and why are people not eating the real meat? Besides, like, they want to protect the environment, but as you kind of mentioned earlier, like, people don't adopt green just because they're green. They adopt it because there's like actual need.
Yeah, so actually, my partners led the media investment, but the shortest version across all of these things is outside of like looking for the entrepreneur who we want to back at the early stage. We do look for, and how much capital it takes to kind of de-risk it. We do look for some fundamental tenets, which is unit economics, ability to scale through a channel, and the team. And when you think about that, the alternative protein, world in general is you have to produce something that is as good or better than, going and buying a sandwich or a burger, right? It has to be healthier and it has to be cheaper. And that is really hard to put in the same package. So what's really happened over time is, Beyond Impossible, I actually find them quite delicious. They're not really any healthier than a traditional burger, particularly like lean, high quality beef. You're not really going to, appeal to a broad base from a health perspective. And most people are not going to choose that unless they're vegetarian already. There is a younger cohort in general that are making kind of some of these life decisions by going like a little lighter on the meat when they can for climate reasons. I'm a flexitarian. So in other words, like if I have a choice, I don't eat meat, but if somebody's serving me, I'm over at somebody's house and they're serving me, chicken, beef, I'll absolutely eat it. But when I have a choice, I don't do it. So there's kind of a whole, cohort of folks that are like that. The problem with those business models, though, is that it's been too expensive to produce the product, and the demand is kind of topped out. The unit economics on producing, some of these alternative proteins are horrendous, and these are daily decisions people make. Nobody's going to pay $20 for a burger on an ongoing basis. You have to be cheaper, and in order to be cheaper, you have to have a lower manufacturing cost. And so for meaty, it's actually in that particular example, it's mushroom roots. It's called mycelium. And it's a specific kind of type of mushroom roots. It's incredibly nutritious. It's like a third of your daily protein with a single serving. It's got a huge amount of fiber. It's delicious and it's cheap. It's very inexpensive to grow it. They ferment it in big fermenting tanks, basically. There's a lot of special sauce that goes into it, but it is not a very complicated manufacturing process versus a lot of the kind of ground alternative proteins. And that's what we look for, something that was potentially delicious, inexpensive, that could scale to a broad audience. They are growing like mad, but even in those businesses, you still have to raise more money. Valuations were certainly a lot higher a couple of years ago than they are today. And that always comes with some social problems.
Totally. Okay, so we have 2 minutes left. I want to talk about like your fundraising journey. So you guys said no to 300 million and then kept it at 275 million. How was the fundraising journey like for you? And then it's like probably one of the toughest like fundraising climate of all time. And you guys been successfully doing so. I wonder, what's the secret there? And after that, if you have time, we can go over like 1 or 2 questions from the audience. If not, like we can just call it a day.
Okay, great. So just to be clear, our third fund, we're done. So now I get to be able to talk about it. You can't do it when you're fundraising. It went really well. So we had about 600 million of appetite for, what we went out with was 200 million on the cover. 250 was the hard cap, and we wanted to establish a couple of new relationships. So we bloated to 275. That sounds great. It was a terrible fundraising year last year. So it looks like this, victory lap. The reality is that Josh and I started Congruent trying to aggregate institutional LP capital into a space that had lost LP monies for 10 years, maybe 15 years at that point, and was the most risk-on part of the stack, early stage. And so going out and raising, we just got rejected. And like that was our job, is like, you tell people what you're doing, you tell them what you're going to do, you just get rejected. And so I think we had, over kind of the 7 years that we've been around now, 6.5 when we went out, at something like 600 people in our like CRM of conversations we had at least one of across, not people, that's institutions. That's very different than the number of conversations you need to actually get somebody in the boat as a new LP. So effectively, we had already kind of built up a head of steam with these conversations where we had been telling our LPs what we were going to do from the get-go. We did exactly what we said we were going to do. We grew the team. portfolio construction is exactly as expected. Performance on paper, without getting details, looks good. Looks like a venture fund, great. And we built these very impactful, portfolios that are making a difference, and we are benchmarked to venture. And we built the team. And the reality is that you're always for the first 3-4 funds, you're in kind of emerging manager jail. There are only a couple LPs who will actually do that. The Venn diagram overlap of LPs who will do emerging managers and climate, it's like not really a thing. And so as you kind of walk through all that, I think what really happened is that while we are not, fully emerged, we are one of the most emerged managers across climate. And large institutions have figured out that there is a real system-wide problem and that there are returns to be made when deployed in decarbonization and climate. And they are trying to figure out a way to get exposure to high quality, investors. The challenge is that there are very few firms that have been around long enough in this cycle to fit that Venn diagram overlap of like decarbonization, non-emerging manager. And as a result, we had just a huge amount of LP interest, which kind of shocked us. We ended up doing that in just over 4 months and single close, which, to be clear, we've never done before. It's like you work with LPs, you just keep working, and you're going to get rejected most of the time when you have those conversations, but it's still been very fruitful over time to establish relationships, tell people our story. Many LPs are trying to landscape to understand what the climate ecosystem looks like. And we've been very open and approachable in having those conversations with intent. We're trying to establish high quality relationships that are going to last over time. So, it seems like it was like a 2023, aberration for us. It took us 7 years to build up that head of steam.
Wow. Only 7 years. I'm just kidding.
Yeah, right.
And then only 600 LPs in the CRM. Like I've heard people I feel like the majority of people talk to like thousands of LPs begging and like eventually got like landed, I don't know, 100 of them or something. But it seems like it's a big work for you. But
yeah, it's almost all been institutional for us. So we haven't taken individual capital. And that means there are fewer conversations, but when you have the conversations, they're usually a lot longer. A win for us may be 40 hours of time with a single LP.
God.
No, it's not for the faint of heart.
That's crazy. But anyway, okay. So do you have a minute to address 1 or 2 audience questions, or you have to go?
Yeah, I think so. I think I have something in 10 minutes, but I'm fine for the next time.
Okay, perfect. Do you want to pick an audience question? So there's Evergrow, Rob, Philippe.
I can't even see. Oh, look at all those. I missed all these. Holy. Okay. Do you want to pick one? I'm just scanning through them.
You pick one. I feel like you pick one. I already picked one for you. So the derms stand out. And the VPP.
All right. Well, derms, I'm in.
This is what we can see. Like typically, there's more questions that we can't see on this because I feel like the system are like not so sustainable. But anyway.
Yeah. Yeah. So the emphasis on hardware and hard tech investment, battery, carbon capture versus software. So I kind of covered this earlier, so I'll make it super brief. We don't have a specific emphasis. We just make sure that something fits that venture model that I was describing. Not all hardware does. So like the battery business by itself, again, you have to go down each one of these little esoterics to understand what works and what doesn't. Battery manufacturing, huge amounts of CapEx, low margin, and you can't even get a purchase order from like an automotive OEM until you've already built the manufacturing facility, because they've got to actually qualify not just the product, but the facility and the manufacturing. So when you're talking about building a new battery technology, best case, that's 10 years and $1 billion. And that doesn't fit our version of venture. There's a huge amount of innovation going on in batteries that you don't hear about that are in like LG's labs. So, you'll have kind of battery chemists show up and say, like, I've got the next best battery. And they may be right in the public domain, but it turns out that somebody else probably has the same thing going on over, in LG's lab. So each one of these things is its own, like, little special sauce. We need new battery technology. There are some very cool companies that are doing great work that kind of aren't out in the public. It's not an area that we will likely invest in at this point. Again, Grace, going back to like your angel investing, in our opinion, batteries are kind of played out from an early stage investing space. But if you didn't know that world, you'd be like, this is really cool. I'll give this, PhD some money. And it's probably a great way to lose money. The DERMS and VPP world, those are also very esoteric. We have a lot of that in our portfolio. We are very excited about the deployment of virtual power plants. It's basically the idea of orchestrating like EVs, power walls, all of these things that a customer might own, and actually replacing like a gas-fired power plant by controlling them all, in unison, orchestration. That we're actually quite bullish on. Understanding how a company is actually going to scale to very large scales in a relatively frictionless manner is quite challenging. We have a couple existing companies. Camus fits into that world on the utility side. They sell utilities. We have another one called Leap. And actually, some of that EV charging fits into that world as well, because you think about those EVs as distributed batteries effectively. I see Felipe here has a question about the influx of capital, sometimes in a non-disciplined manner. It's very diplomatic. Into venture affecting climate in 2019 and 2020. The feature and bug of kind of the emerging universe of climate is such that there weren't that many late stage companies in climate in that kind of ZERP world, 2020, 2021, where there was a horrendous amount of completely ridiculous markups. The stories of $1 million ARR business going for $1 billion, valuation, not a thing in climate. There were a couple of these kind of like first wave, very capital intensive businesses that had some of those dynamics. Some of those are going to survive, some of them are not. But in general, from a system level standpoint, the climate world was not nearly as exposed because we didn't have as much late stage, companies out there. When we went back in 2017, it was really, trying to build the early stage companies to back up after everybody had left the building from kind of 08 to 2016. We weren't the only one, but there are a lot more companies that are now getting to that late stage today than were at that late stage in kind of the 2020-21 period. And so it's not to say that there was some lack of discipline in some investments, but at the kind of system level, I'm not overly concerned. One thing I am a bit concerned about is that if you kind of look through the venture capital stack, pre-seed, seed, and like early A, where we actually play, is pretty well funded. There's been a lot of wonderful people coming in. And so, I'm not actually particularly concerned about the valuations there, but the capital, there's a nice supply and demand of capital and entrepreneurs actually in early stage. Series B and C is a little murky right now. There aren't enough large dedicated climate firms to support all of these Series A companies. And so you have to believe that mainstream tech is going to come in and invest in some of these climate companies. And all evidence suggests that the mainstream venture firms are in fact coming in. But the business model needs to look like something that they can underwrite. It has to be a deep tech firm. It has to be a SaaS firm. If you're doing a deep tech deal, you need to have deep tech expertise. If you're doing a SaaS deal, you have to have SaaS expertise. And so each one of those business models across the portfolio has a completely different set of kind of follow-on constituents. I think we've now co-invested with like 270 different firms over the last, we were counting this, over the last 7 years, which is mind-boggling. That was way more than the first 13 years of my venture career. So that's a whole another digression. But we do need more capital in that kind of Series B and C ecosystem.
Mm-hmm. Amazing. Okay.
Any other? I mean, I could keep going on this, but I think we're going to come up on time. Grace, do you have any final thoughts?
Questions? Yeah, I love this. And then obviously the audience love you. You have to come back to do another one sometime. And anyway, so I have a one, like literally 30-second viral for you. What's your favorite book?
You think I read anything other than about, climate change these days?
Oh God. What's your content diet?
My what?
Content diet.
Content diet. Oh my gosh. Newsletters, some podcasts when I'm running around. Our office mate Shell Khan runs a podcast called Catalyst that I really love. He's with Energy Impact Partners. There's a couple great podcasts out there like that.
Amazing. Okay, so who made the biggest impact in your career?
Probably my old firm had a couple founding partners who were just kind of at their own expense, oftentimes would invest in the younger generation. And that's been just a massive, learning experience. I got to benefit really from a host of mentors actively investing, in me in my early career. And I'm really grateful for that.
Who would you invite to your dinner party?
These are probably questions that I should have known about before and haven't answered.
I'm sorry.
I would like to have a conversation, like a sit-down conversation with like Al Gore about some of the history of, how he has viewed, climate. And I have not had the chance to do that.
Where can we find you outside of work?
Playing with my kids and my wife.
Amazing. Well, thank you so much, Abe, for coming on to the show today. I'm sorry we went a little bit over.
No, thanks for having me. This is a blast.
Okay, let me just quickly unstream.